The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Go.
Hey everyone, welcome back to another episode of In the Market Trenches. If this is your first time checking us out, we're available anywhere podcasts are available. You can check us out at inthemarkettrenches.podbean.com. You can check us out at snn.network. You can check us out on the SNN YouTube channel. That's youtube.com/SNNwire. I'm Eric Furey. I'm joined here with my partner, Gary Ribe. We have a very special guest for you today. If you spent any considerable amount of time in the microcap land, here he is, Paul Andreola. Paul, welcome. Thank you for being here.
Hey, happy to be here. Thanks, guys.
Well, you're something of a legend among Canadian small and microcap investors. So we're really happy to have you on. Can you just give us a little bit of, for people who don't know you, a little bit about your background and what you're working on today and all that sort of stuff?
Sure. So I'm located up here in Vancouver, Canada, and I've probably spent the last 20 or so years in the capital markets, really focusing on microcap stocks. My background or education has very little to do with finance. I studied construction management and spent some time working in the construction industry, but really had a passion for investing. Started reading everything I could on the investment game. Became a broker for about 10 years. I think maybe honed my investing skills a little bit working in the industry. But even that wasn't really exactly what I wanted to do. So, I was always finding that my portfolio was probably generating more income for me than any sort of commissions or any fees that I was generating. So it made more sense to focus on that. And that's what I've been doing. I've been sort of looking for microcap investments for the last 20 or so years, and been fortunate that I've caught a couple of really good ones. And right now what I do, along with one of my analyst partners, is I write a newsletter called Small Cap Discoveries, focused on trying to find the best microcap companies that are publicly listed up here in Canada.
Got it. And in addition to doing the newsletter, you guys are also hosting some sort of conference in January?
Yeah, so I've teamed up with Bobby Kraft at SNN Network, and we have a virtual conference that we're presenting January 6th and 7th. And it's Canadian themed, so it's all the presenting companies are Canadian listed companies that we think are somewhat undiscovered or mispriced, or have something that we think will appeal to a broader investment audience than just the small amount of Canadians that are up here huddled in the cold.
Nice. Eric and I have a soft spot in our heart for some Canadian companies because some of the things that we've most loved have been sort of off the run Canadian dually listed things for sure. So we've got a soft spot in our heart for that.
Awesome.
Eric, I interrupted you. I'm being rude, which is very un-Canadian of me.
Where can people go to find out more information on the conference?
You'd have to get back to me on that. SNN Network will you'll be able to find the it's Canada, so CANADA.SNN.network. You'll find all the information you want right there.
Producer awesome. Bobby with the save.
There you go.
That's right.
He's counting Bobby.
Give the hat tip to producer Bobby. So Paul, you're pretty well known within the microcap circles. Our show, what we do is we like to sort of delve into people's past experiences, usually something that people are no longer involved with, lessons learned. We find that you learn the most when either things didn't work out exactly as you hoped, or for one reason or another, it was really a suboptimal outcome for somebody. And that's the whole point of our show. We were talking beforehand. You've got a lot of different stories. Which one would you think would be very interesting for our viewers, our listeners?
So, one that probably gave me the biggest lesson especially relevant to the microcap space. I don't think those that are investing in the microcap space aren't looking for a 10 or 15% type of annualized return. You're looking for big winners. Microcaps are really where I think you can generate a significant amount of wealth. And the story that probably taught me the most was still a winning story for me, but I learned that you want to hold your winners as long as you can, rather than just taking a win for the win column. And it was a company called Bowflex, and I can't remember the exact year, but it was relatively early in my investing career. I had a strategy on how to find stocks, which was starting to work out well, but I had a very poor strategy on how to hold stocks. And
why don't you start with the beginning? What was the search strategy that led to you finding Bowflex?
So one of the books I read that really changed my financial sort of strategy and life to some degree was a book called How to Make Money in Stocks by William O'Neill. For a lot of people, it's a bit of a Bible, and it certainly really changed the way I looked at finding stocks. And the thesis or the main criteria behind it is you really want to find companies that are growing very rapidly and are not needing to constantly refinance. So you want a company that likely has high revenue growth and earnings. And if you can find those, there's some other sort of technical factors you look for, like the stocks hitting a 52-week high, and some things that really were not sort of taught to me, in sort of the sort of normal course of financial education. It was always buy low, sell high. The premise of buy high and sell higher was really new to me. So this book really changed the way I thought. And so I built a strategy around trying to find these companies that had those sort of three things going for it: high revenue growth, profitability, and then hitting new 52-week high. And I really stress that still to this day. So I started reading through CDR filings. I started literally going through all the financial filings up here in Canada. Found this little company called Bowflex, and if anybody is old enough, they might remember these crazy infomercials that you saw on TV. And it was crazy. They were selling these what looked like rubber bands on a piece of metal, and it was exercise equipment. And you typically see these infomercials at 2 o'clock in the morning, and but it was working. The company was growing at 200-300% a year, and it was doing that for year after year. And I managed to, fortunately buy in relatively early, and about a year later, the stock was trading, sort of 50. And I thought, well, this is great. I'm up, I'm making money, and I better jump out before it goes back down. And that was my big mistake, because the company just kept putting out the numbers and kept growing and kept growing. And subsequently it went, I think, after accounting for splits and everything, up to about there. So yeah, I mean, so I look back and I try to really understand why I sold it, and ultimately it was because I was up. That was the only reason. So again, you learn to hold your winners in the microcap space. Otherwise, you leave a lot of the profits on the table.
So how would you go ahead, Gary?
No, please.
So looking back on that situation now, if you were to replay that, obviously the outcome. What's the internal dialogue that you go through to give yourself the conviction to continue to hold that?
So, I mean, that's exactly it. You use the word conviction. I think that's vitally important, that you have to know enough about the company so that you can gain that conviction you need, because it's rarely a straight line up. There's always going to be hiccups. There's always going to be issues, and you have to have that sort of internal fortitude to understand that this might be, it might be fleeting. The issues they're facing might be temporary, or the valuation issue. I remember looking back and say, okay, well, it's gone up, 5x, so therefore it's not cheap anymore. That's not the way the real world works, and you've got to have in advance a sell strategy that is conducive to these type of companies. you can think back of all the other, big major wins over years, and there's always a time where people thought it was expensive, and yet it goes up another 10, another 20, another 30 times in value, because you're not properly valuing. You're taking sort of a value approach to a growth strategy, and if you do that, you're going to leave so many winners on the table.
Yes, I think if you look back on the vast majority of value managers, a lot of them will, I've listened to a lot of them give talks, and a lot of them will say the same thing. It's like, my biggest sin is I sell stocks too early. And it's sort of like, well, if that's your biggest sin, don't you want to go back and sort of do a postmortem on that and maybe solve for that problem? And like, I don't know. But at the same time, it's hard to sort of balance the being grounded in some rationality versus falling in love with the stock, and so how do you play those off against each other?
Well, I think the advantage I have now is I've got 20 plus years of experience in dealing with growth stocks. So you come to know that more times than not, you're still mispricing it. You've got to understand the valuation metrics that are really key in a company that's growing very rapidly. You can't tether the valuation to a price earnings ratio by itself. You've got to use other factors that will allow for that kind of rate of growth, so that you maintain a degree of comfort. And as well, sometimes in the short term, the stock will just be overvalued. And as long as it's growing, that overvaluation will sort of, the company will catch up to its overvaluation. So you just have to know these things and be prepared for those bumps in the road.
Yeah, I think as Eric and I evaluate ourselves and things that we're involved with, I think as we sit here and look at it, like some of the worst reason for us to sell is sort of the valuation side of it. But it's also hard because, if you've got intrinsic value growing at a decently high clip, and you're going to trade at premiums and discounts that all along the way, how do you resist the urge to trade around it, or you just sort of try to sort of forget about it?
You know what? So there's I'd almost say a psychological training that I try to enforce in myself. So sometimes if I think I'm going to trade, like I'll trade. Like I will trade around a position to keep me from doing other stupid things. So sometimes you sort of have to feed your personality. If you think you want to trade a little bit, then trade a little bit, but have it as part of your long-term strategy. So it's like there's nothing wrong with being a little bit wrong every now and then. Maybe you trade out of a position and you don't get back in. That's fine, as long as what you do sort of 90 to 95% of the time is still, that sort of core process or strategy that you live by. So, I think you have to build your strategy that fits your personality. And if you're inclined to want to trade a little bit, but make sure it's part of that overall strategy. If that makes sense.
It makes a lot of sense. I like that. It's that's a pretty unique perspective. You don't hear that from a lot of people. I get one of the other questions I have. It's something like a Bowflex or one of the other names that we might get into later. As these companies become more and more successful, you get more and more eyes on these companies, which opens up more and more criticism, challenging the analysis that you've done. So how do you kind of block out the noise? As there's good noise and bad noise, right? You want to be open to good criticism and good feedback and be open to other opinions. But at the end of the day, this is your capital that you're managing, and you want to stay grounded to the thesis that you originally bought into. So how do you kind of sift through the noise and block out the noise that's not appropriate?
Yeah, no, I learned a while ago that the more you do just that, sort of restrict the noise and stick to sort of key criteria or key facts, the better. But what I'd actually say is that what you want to do is you want to invite criticism. You want to invite those arguments that go against your thesis, and be inviting to that, because you have to continue to test your thesis if you want to be successful. And where I really think it gets dangerous is when you're going to look for validation of your thesis. If you keep doing that, you're going to get that kind of thinking that doesn't allow you to see the issues coming when they come. So
Yep.
invite criticism, invite, an alternative idea if you really want to try to, adhere to your strategy. I mean, it's vitally important that you listen to somebody who might have a different view on something than you do. They may be wrong, but that'll help you validate your thesis if you continue to look for that criticism.
So now, Paul, you write about your ideas publicly in your newsletter. How do you balance? So there's oftentimes there's going to be times where you're right and you've got big winners, and there's going to be times where you're long and you have losers. How do you? Maybe we can get into one of the losers a little bit later, maybe some of the lessons from the losers. But when you're writing about your ideas publicly, how do you try to avoid? And I know a lot of investors that will not talk about a current idea publicly because they're very hesitant to become sort of anchored to some belief in the defender of an idea and that sort of thing. How do you think about that? And was that a problem for you in the beginning? Is it sort of evolved over time, and sort of help us understand that aspect of things? Because I think it's interesting when you're public with your ideas.
Yeah. So early on, it was ego bruising to hear others, say something negative about an idea I had. I think there's a bigger thing. It's the universe, and I want to sound too out there, but the universe has a funny way of just making sure that common sense prevails in the long run. So if you're out there with an idea, it's only as good as what how close it is to reality. So if I'm out there saying something publicly, I'll get slapped in the face if I'm wrong, and it should happen sooner rather than later. Otherwise, it's going to hurt me more in the long run. I don't know if that makes any sense, but I've got no problem really being public about some of my ideas or even some of the stocks I'm involved with, because I think ultimately the world will sort of work around me anyway, right? If I'm wrong, I'm wrong. The sooner the world comes and tells me I'm wrong, the better for me. If I'm right, well, then the same thing. It helps sort of. It helps the thesis meet its end goal faster.
Right. How long did it take you to learn that? Because I feel like a lot of beginning investors, they really want to be right more than they want to make money. And so, it's one of those things that it can be a tough lesson. It might be one that you have to learn it again and again and again before you really internalize it. Do you have any, I guess my question is, how long would it take you to learn that? And do you have any advice for anybody or suggestions for anybody who might be having a hard time with something like that?
Know your personality, like know who you are, so you can, if you're willing to take a lot of criticism and you're prepared for it, I think then you're more likely to be successful. I think it's very difficult early on because you're right. Humans want to validate themselves by being right or being shown that they're right. That doesn't necessarily make you money. We're in this business to try to see if we can't generate, increases in our capital. You have to learn to be wrong. You have to learn to be wrong quickly. And when you're right, you have to learn to stay right as long as you can. So use whatever tools are out there, whether it means it's somebody else, whether it means you're going to write your thesis on this company and post it publicly and have somebody criticize it. You want that. You want to get to the truth and the answer as fast as you can, and use that sort of validation method, being the internet, or being, a community of investors or whatever. Use that so that you can thicken your skin and be prepared to be as wrong as quick as you can, as often as you can, and be right as long as you can, and gain as much as you can from that win.
Now let me ask. You mentioned a few different things in your story that I thought were worth maybe digging in a little bit more on. One of the things that you look for is sort of a stock at the 52-week high. Can you sort of expand upon that a little bit? That's sort of counterintuitive for a lot of folks, in terms of wanting to buy things low. If you're talking about buy high, buy higher, can you just sort of? I can think of some reasons why you might want to do that, but I'd like to hear them directly from you. I don't want to project onto you what I think they might think.
Yeah. Okay. So think about every great company that's gone up 100, 200, 300, whatever times in value. One of the common denominators of all those companies is that they at some point had to hit a 52-week high, right? So if you take that into consideration and you're looking for, like, I'm not looking for something that's going to go up 15 or 20% value where, or certainly I'm not looking for a purely a value situation where it's trading at 50 cents on the dollar. Because at best, if it goes back to fair value, you're making 100%. I'm looking for something that's going to go up 10, 20, 30 times in value. And to do that, one of the common denominators is at some point they got to hit a 52-week high. So that's one of the things. It sort of shrinks my universe of companies that I'm looking for. And then psychologically, there's a factor as well, because we're ingrained to think we want to buy low and sell high. Usually you get a major inflection point when a stock breaks out of a congestion pattern or breaks out to a 52-week high. That basically means that anybody who is tethered to a price has sold their shares, and now you're looking at brand new sort of brand new territory in terms of prices that
new shareholder base.
Exactly, you're looking at brand new shareholder base, right? So if you're really into technicals, you understand that you're breaking out to a new level, and exactly that, you got new shareholders that
is it strictly price level, or is it market cap of the company, or is it both?
Well, okay, so now we're going to get into some finer details of this. So you're really looking for psychologically, people are tethered to price and not as much market cap. If a company is buying back their shares, and of course their market cap is technically decreasing, even though the share price is staying static. So there's sort of two answers to your question. One is the psychological factor of the breakout into 52-week highs, but ultimately you want to see a company that's growing in value, so you want to see their market cap growing.
So as part of your main thesis on this, one part technical in the sense of a trading type thing, but then also part a company that's growing in value, intrinsic value very rapidly is likely to be at a 52-week high.
Yes, more times than not that's happening. And what I've always said is you're using fundamentals to determine which stock to buy, and you're using the technicals to tell you when to buy. So if you can get all those things going, obviously you're increasing your odds that you've got something that's going to see a more rapid recognition in pricing.
Got it. Mm-hmm. Eric, did I interrupt you with a question?
No. Do you want to go to another story?
Yeah, why don't we go to another? I mean, I'm sure you've had some things that haven't worked out over time where you've bought something at a high and it looked like it was growing, and for whatever reason, it didn't sort of pan out. Maybe if you could walk us through one of those and sort of how things went along the way, and sort of maybe some lessons learned on that. And so I feel like if you're pursuing a strategy where you're buying at the 52-week high, you got to be very watchful that the story doesn't change in such a way where you get whacked hard. So
yeah, now, I mean, so I don't blindly buy just because those factors are in play. I still look at some sort of valuation thesis, right? So whether it's price to earnings or price to EBITDA or something that tells me, okay, even though it's gone up in price, there's still some sort of value in comparison to its growth metrics. So there's a margin of safety you're always looking for. So that protects you somewhat. But I mean, I got to tell you, of course, there's been a lot of examples. I probably can't even count that high as far as companies that look like they had everything going for it. They're breaking on 52-week highs, and the next quarter, for whatever reason, they miss their numbers, and then all of a sudden you're underwater. So that happens a lot. The way I protect myself around that is that I never go all in and take a big position day one. I'm looking, at sort of the idea that maybe a third or some form of starter position. I've got my starter position. Now I'm looking for a reason to add to it, and that's only going to come over time, and it's going to come through execution, and not just execution on the business, but execution on share action as well, price action. So yeah, that's about the best way I can protect myself in those circumstances.
And so are you sort of, when you take that starter position, you're sort of seeing how it feels owning it, seeing how you feel following it, seeing if the guys that are running it do what they say they're going to do, and sort of all of those sort of things? I mean, so you take a starter position, and how long does it take you to build to either build to a real position or sort of get out?
So it's sort of up to the specific circumstances or the opportunity. So it can take years to build the full position. I mean, there's stocks that I'm still adding. I started buying 3-4 years ago, and I'm still buying now. There's others that I'll start buying a position, and 2 or 3 weeks in, I realize I've made either a big mistake or I've missed something, or management does or says something wrong, and I'm out. I don't think there's a hard and fast rule in terms of timing. Each circumstance is different, but it's key for me that I don't enter my whole position early. I'm looking for validation.
And is that validation, or when you increase that starter position, is it mostly being increased because fundamentals change? I could say increase or decrease, or are you doing that also based on some technicals? If you have the same fundamental reason that you established a starter position, but the price for one reason or another started to drift back down, are you going to look to add there, or is that something more of a trade? How do you think about that?
So this is where I leave it a little bit open, because I do tend to trade on some technicals. So if there's a good solid trend as far as price action, and I still like the stock, and the stock still is cheap by my measurement, then I will look for little opportunities to add to my position based on maybe it's hitting its trend line on the way up. So there's that, and then sometimes the trend breaks, but I've still got very high conviction on the stock. Now I'm going to look for an opportunity where the stock is really based out. The fundamentals, as long as the fundamentals still look strong, I'll take even a longer term approach and say, okay, the technicals aren't going to be on my side right now, but the fundamentals are so compelling that I'm still going to trade or still going to add to my position here. So there's different factors that come to play. But sure. I'm either buying longer term for the fundamentals and not caring about the technicals, or I'm adding based on decent fundamentals and the technicals look more appealing.
Got it. All right.
No, go ahead, Eric.
Sorry. Oh no, I'm going to go off on another tangent. So you wrap this one up for us.
I wasn't going to wrap it up. I was going to go on my own tangent. You want to have tangent corner? What's your tangent?
Well, my tangent was we were going to jump into a story where everything just kind of went against them, and that's what I wanted to hear about. So that was my tangent. What do you got for me?
I got one tangent to go down before we go down that tangent. So you put a pin in that one for a second, and then we'll circle back to it. So it sounds like a key element to what you're doing is you're talking about conviction, and that's conviction in sort of the growth of the enterprise is it's growing at a very fast rate. So how do you go about getting that conviction? What's your diligence around that? And how are you evaluating it? Is it TAM? Is it that they're eating? Is it an end market that's growing? Is it share? What are the common things that you see where you're building confidence?
So there's a lot of factors, and a lot of it comes from the years of experience of doing a lot of things wrong. But we look. I look for things like, nobody's talking about this company, right? I phone management and they haven't had a shareholder call them in 6 months, right? Those things are weird anomalies, but they give me an extra layer of confidence because I know that I may be the only one buying it, and that's part of the reason why the stock is trading or it's valued where it is right now. So it's weird things like that. The one thing I haven't mentioned that I think is really key is that I don't just measure it against itself. Like when I look at a stock, I look at all the pieces and I measure it against everything else in my portfolio. So for it to become a significant position in my portfolio, it has to be significantly better than something I've got very high conviction on. So it sets the bar quite high. So to do that, now I've got to make sure that it's undiscovered, mispriced, starting to trade properly. I'm a whole bunch of things where some of the best stocks I've got in my portfolio are already demonstrating that. I've already got conviction. I know management. They've executed. They've proven they can execute. So it's tough for me to build significant conviction in something else unless it's really already starting to prove itself quite a bit. That makes sense?
Yeah, and your opportunity set. So you mentioned having to are you normally fully invested with this, or do you normally have some, are you normally running fully invested? So like, the opportunity cost is another idea?
Yeah. So I think that's, again, knowing my personality, I have a very hard time holding any significant amount of cash. So what I'm always looking to do, I kind of use it as it's almost like a sports franchise, right? I've got really good players and I'm constantly trying to find somebody to trade for. And if I can't find somebody better, I'm just not going to trade that player, right? Mm-hmm. So there's no point in holding cash. I feel that at any one time, I've got, maybe 5 to 10 of the best players that are out there.
Mm.
So that's interesting. So are you familiar with Googie?
Yes. Yep.
Yeah. So we had Googie on, I don't know, a couple of weeks ago. Great investor. And one of the things that he said and that he wanted to really reinforce in the podcast with him was be prepared for this idea that you're holding losers. Mm-hmm. And so how do you identify, and I think he's right. I think your batting average isn't going to be 100%. If it is, kudos to you or whoever out there. So how do you go about that evaluation process of your names? Obviously, you're looking at it in isolation, but that when you're looking at that opportunity set, how are you doing it in a way that's kind of unbiased and you're not tethered to a previous thesis that you once had as you're trying to trade players in and out?
One of the advantages I have is that I flip over a lot of rocks. Like I really, really look at a lot of opportunities. So there's quantitative facts that I have to deal with. And if one company is growing at 20%, another one's growing at 50%, it's pretty easy to see which one should, start to get more of my attention. Again, it's important you have a set strategy in advance and you've got some form of criteria that you're going to abide by. Otherwise, if you're sloppy and you don't, stick to your process, you're just not going to perform well. So I'm constantly looking. That's sort of the motivating factors. I'm trying to find that one that can replace my weakest link. Right. And I will find it. Like I know I go into all our due diligence, and when we're looking at sort of in Canada, it's CEDAR filings, right? It's like Edgar down the States. Yeah. I know there's a gem in there somewhere. I've got to go find it. That's my job. I just got to go find it. And because I'm not sitting on cash, that means I've got to compare it to my weakest link. I'm constantly trying to groom that. And it just happens. Yes, I get losers. Sometimes they make it real easy on me because they completely, crap the bed, however you want to term it. And it becomes very obvious. I had that happen just a couple of weeks ago. There's an issue with a company that was, very obvious, and no bones, no nothing. I sliced the head off and it was gone out of the portfolio. No questions asked. That's what happens. I mean, nobody hits 100%, like you said, or bets 1,000. That has to be sort of part of the process and strategy. You're going to get a loser. Yeah. Deal with it early. Just don't mess around. Yeah.
It's funny. People. It's funny. It's like it's good. It's like also good marriage advice. Just learn to admit that you're wrong early. It costs you less in the long run.
Absolutely. I think there's a lot of analogies. Investing in marriage, there's probably a lot of similarities in a lot of ways. Yeah.
Yeah. Eric, you want to go on your tangent now?
No, and I fully disclosed my tangent. We know what it is. Let's talk about a story where you cut the head off of a name. Things went south on you, and you cut it out of the portfolio. And we all are faced with those types of situations. So do you have anything you could share with us?
I've got one that I'm still licking my wounds right now. It's the story I sort of just referenced right now. It's a very long-term holding of mine. It was a company that was private that went public. I had helped fund the company early on when it was still private. Helped fund them when they went public, and helped fund them all the way along. I'm going to say close to 20 years in terms of how long I was holding this company.
Wow.
they would have glimmers of, I'd say more than glimmers, they were having some great progress executing and doing the right things and hitting milestones, and then the legs were chopped out from under them. They lost a very significant contract that was a significant part of their business, and the knowledge or experience that I've had that typically when something starts to go wrong, it's seldom in isolation. There's other things that happen with it, and it was clear that it was the weakest link in my portfolio, and and being sort of what we do with writing a newsletter, I was very public about it. Made a statement right then and there that this was going to be exiting my portfolio as fast as possible, and that's what we did. We got it out as fast as we could, and had cash available, and now we were energized to go and find something that would replace it. I think something that investors have to understand is there's not just the sort of the financial currency you're working with, but there's also the mental and emotional currency. How many times have people sat on a loser because they think they just want to get back, another 10%, or trying to have it bounce a little bit, and meanwhile they're sort of missing all the other plays that they could be working with, and just sort of it messes your head up. It's just not worth it. So there's a really big psychological component that investors really have to understand their personality to be able to make it part of their sort of investing criteria.
Yeah, Eric and I have this one all the time. There's certain companies that we just stay away because I'll say to Eric, I can't objectively evaluate this. I have too many feelings about it, and it's just sort of it's the mind space issue. So it's like the bandwidth is so valuable. Why waste it on things that just are going to inflict brain damage?
Absolutely, and you get clustered up into something you can't think properly, and it's so important that you leave emotions and your mental state out of investing. That's the beauty of this is the more sort of robotic you are in sticking with your process, typically the better you do. So take emotions out, and because I know my psyche now, I don't want any leftover emotions. Cut something as fast as you can and on to the next one.
20 years is a long time to be involved in something. What finally made you say enough is enough?
Well, it's sort of like what I mentioned. It's my experience. I know that you don't want to have a okay company in your portfolio, right? You really want to try to strive to have, if your portfolio makeup is 10 companies, maybe 12, and 8 of them are your key positions, and the other 4 are kind of your starter positions. You want to constantly go out there and say to yourself, I know that these are the 10 best I can find, or the 12 best I can find. If you're doing that, you can gain more conviction in your holdings. You can hold them longer. You can hold them through bumps in the road. It's amazing how important it is. Like, we're not looking for companies that we think are okay or good. We're really trying to find opportunities that are absolutely fantastic. Otherwise, what's the point? They're there. You might as well go find them.
Mm-hmm. Yeah, I think that makes sense. How do you, just by the nature of sort of the rocks that you're flipping over, how do you differentiate between something that's a real story and something that's more of a story stock?
Yeah, so I mean, in the microcap space, I'd say 80% are more story than real, maybe even higher. It's tough. It's tough because I've been around the block a few times, and I know sometimes story stocks can do real well, and how how it all works. We see a lot of manias over the last 25, 30 years, whatever. And you have to be disciplined enough to sit there and say, okay, that is not the criteria for a company that I'm looking to invest in. And even though I know it's probably going to do well in the short term, I can't build enough conviction around that to be able to build a big enough position in the stock so that if it does work out as well as I think it will, it's going to have a meaningful impact on my portfolio. So for me, it's it goes back to the word conviction. I've got to be able to have enough conviction and to own a material amount of that stock, or at least have the ability to say I may add to my position so it's a material amount. And the story stocks just won't cut it. Like if the fundamentals aren't there, if all the other pieces that are needed aren't there, I just won't build a meaningful position. So what's the point?
And when you're doing this, do you get to know the management and the management team and sort of, all that sort of stuff? Or are you sort of how closely tied in are you with those folks that you got your finger on what's going on? It sounds like you run. Did I hear you right, about 8 to 10 sort of core positions?
Yeah. I mean, I probably right now have about 15 positions in my portfolio, but I'd say a good 7 or 8 are the majority of that.
All froze.
Yeah.
Or maybe I froze.
Oh, you froze a little bit. I'll just continue, but yeah. So it's typically about 8 to 10, I'm just. It goes back to the theory before. I'm constantly trying to find something to replace it. Your question was more around management. Like what usually happens is I'll build a position well before I speak to management. The numbers and the price action will probably tell me more about what's going on than the management team can tell me. What I want to have after speaking with management is just they sort of validate what my thesis is, or they don't say something or do something, or I can tether some action that they claim is going to happen or something, so that I can go back and review if it was correct or not. How ethical are they? How honest are they? How you'll find in the microcap space that a lot of these CEOs or management teams are they're excited and they want to tell you everything about the business and where they see the business going. So it's pretty easy to sort of validate that after the fact and see if they're if they're living to what they're saying or offside in any way. But talking to management, I don't believe is as important as a lot of people think. I know a lot of really good microcap investors that spend very little time talking to management, and if anything, sometimes it actually will poison your head. Because you build a bit of a relationship and then you become a little too trusting, and when something starts to go sideways, you're willing to give them a chance. That can be dangerous, right?
Yeah, we always try to be very careful with that ourselves. I mean, there's a fine line between sort of being involved and then too involved to evaluate it objectively or evaluate the person objectively. So it's you have to be very, very careful in our experience. Anyway.
Yeah.
And I'll say one other thing is that there's been circumstances where I've actually started to build a position before talking to management, and then I'll get on the phone with the CEO or somebody there, and immediately start selling the stock afterwards because they'll say something or do something that just is offside. I mean that I probably sold more positions after talking to management teams than bought positions after talking to management teams. It's that 2 or 3% sort of validation I want to hear from the CEO. If he says something wrong, I could completely throw my thesis out the window.
Right.
Mm-hmm.
Yeah. Cool.
Mm-hmm.
We're coming up to about an hour now, right? We're pretty close to it.
Yeah.
So Eric, do you want to sort of any final questions? I've got one, and I guess it's what do you know now about investing that you wish you knew when you were starting out?
That the smaller investor has a lot more advantages than they think they do. I'm convinced that there's opportunities out there that can completely change your financial life if you look hard enough. Be prepared to do uncomfortable things and go look in places where others aren't looking. The idea that somebody, because they're an analyst or a fund manager, knows more than you is not true. And really, I think it's more about emotional literacy than it is financial literacy in terms of being good at microcap investing. So it's easier than people think, but there's more work than people think in this space. And if you know what you're doing, anybody can, make a really significant financial difference in their life.
Great. Eric, any closing questions? Do you want to land the plane?
I have nothing that could follow that up. That was the perfect way to end, Paul. Thank you. That was so well said. That was great. Thank you so much for being on the show with us. I really enjoyed it. I don't think we've seen each other for a number of years now, so it's good to see you again. Good to catch up. Thank you. What are the dates for the conference next year? I know we could check you out. It's canada.snn.network. What are the dates?
It's January 6th and 7th.
Great.
And so a couple weeks away, pretty soon.
And the location is the interwebs.
It's the interweb, exactly. Yeah.
Thank you. Thank you, everyone, for joining us. Remember, we're available anywhere podcasts are available. You can check us out at snn.network. You can check us out at inthemarkettrenches.podbean.com. You can check us out at the SNN YouTube channel. That's youtube.com/SNNwire. Gary, always great to see you. Can't wait to see you again in person, I think tomorrow. And Paul, thank you so much again for being here. Really enjoyed it.
Thank you, Paul.
A lot of fun. Thanks a lot, guys.
The information in this podcast is educational in general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.